Good morning, everybody. It's Wednesday morning. Yeah, Wednesday morning if you're on the West Coast like me. Wednesday afternoon if you're Central or Eastern time. So good afternoon to you. Thank you for spending some time with me this morning, or today rather. My name is Martin Traub-Werner. I'm the founder and CEO of VetBooks. And I'm just going to give a minute here to let all the participants roll in. It looks like that's happened. Yes, that has happened. Great. Okay. Today I'm really excited to talk about the P&L. It's a weird thing to be excited about. I happen to love the P&L, and I'm excited to share some of the reasons for that. A couple of quick things. We've got Caitlin supporting us on the back end of this webinar. If you've got questions or comments along the way, feel free to use the chat function or the Q&A function. I've got my contact info up here. Caitlin's going to drop that into the chat as well. And you should feel free to reach out to me with any questions, comments, concerns after really, truly any time. You can also find me on LinkedIn. This is a RACE-approved webinar, and we'll drop the link to the certificates towards the end of the webinar into the chat. Okay, so VetBooks. Quick bona fides. VetBooks is an outsourced bookkeeping service. We are a solution to sole supplier bookkeepers, and we give practices their time back. We work exclusively in the veterinary channel, exclusively with veterinary practices, and exclusively with independents. So no corporates, nothing but vets all the time, all independents all the time. We're lucky to have a number of our clients on the line today, and we're super grateful for their confidence. VetBooks is a passion project of mine, and it's born from this realization that anytime I am wondering about my business, either, and this is historically, I've been an independent business owner, supporting veterinary businesses for almost 15 years. And anytime I've been running a business and I sweat a little bit, or either the good sweats like radiating with joy and excitement, or the bad sweats radiating with pessimism and fear, I always come back to the P&L. I always come back to my income statement or a projected income statement, because the P&L tells a story. And today I'm really excited to sort of transfer my enthusiasm for the P&L, and hopefully I get you to love your P&L a little bit more. So at the end of our time together today, you should be able to speak with confidence about what a P&L is, understand the key elements of the P&L. We are not going to do P&L analysis today. I will give some very basic, very high level sort of entree into analysis at the end, but this is not a P&L analysis. This is really the core guts of the P&L, the income statement. It's okay, even expected, that you would leave with more questions than answers. And I have to make an important note about benchmarking. People, when I give this, and I've done this webinar a number of times, this presentation a number of times, people are always like, well, what should my number be? What is the right number? And I increasingly, and ironically, given my background, am sort of frowning on the idea that there is a right number that you should be targeting, and rather have increasingly leaned on the importance of internal benchmarking. Know your numbers cold, set targets that work for you. Yes, it is okay to compare yourself to others, but compare yourself to yourself and make sure that you're hitting your goals and managing your business to hit your objectives, and put that as the North Star of your business, and not, looking left and right, wondering how others are doing. Learn from others for sure, but play your own game and being intimate with your P&L, really knowing your numbers is a key element of that. Okay, what is a P&L? First of all, it is a P and L, profit and loss statement, not a P&L, which I don't know what that stands for, but people insist on calling it a P&L. It's a P and L. It's the statement of income and expenses, or also known as the income statement. And it is your, as I just mentioned, it's your North Star. It's the guide of what's happening in the business. Importantly, you can use last year's P&L as a guide for budgeting purposes. So you take a look at how you performed every month last year, and this year compare yourself to last year to see how you're performing. You can even be forward-looking and say, okay, I can take, now it's October, I can take a projected P&L for 2025 and say, okay, what do I want my 26 to look like? How do I increase my revenue, decrease my costs, increase my profit for 26? So it informs a budgeting process. A P&L is different than the balance sheet, right? So the P&L is the rolling story of what happens in the practice, and you can sort of look back and see how the progression happened. Whereas a balance sheet is like a photograph. It's a point in time snapshot of the business. It says, you know, what do you own, what do you owe, and what's left. That is different than how you performed on a daily, monthly, quarterly, annual basis. And it's also, the numbers on the P&L are different than the numbers on your tax returns. There's the P&L obviously totally informs your tax returns, but there's a whole other form of dark arts and wizardry that our accountant friends, our CPA friends are involved in, that add tremendous value to the business, but that's different than the bookkeeping and the P&L. And so the two are closely related, but different. So here's a quick look at what a P&L looks like. This is a simplified P&L. It's got revenue and cost of sales and expenses, and you get to some element of profit, and we're going to look at each one of these. But it's important not to be deceived, because this is a roll up, a high level of just revenue, one line item revenue, right? What it actually looks like is when done right, or when done with granularity, there are ways to do a P&L that don't have this kind of granularity, and we're about to talk about the AHA chart of accounts. But when done right, it is a nitty-gritty story of every major line item that generates revenue, every major line item that generates expense, and the profit that results from each of those revenue and expense generating activities. So there is, I like to say, and this is an eye chart, this isn't intended to be read off the screen, it's an eye chart, but I like to say that when done with granularity, making up a number, 90–95% of the questions that you have around your business can be answered by looking at this granularity. Okay, so the chart of accounts. You may have heard of a chart of accounts, and the chart of accounts is, or any chart of accounts, right, is the filing system for the money in the business. And in veterinary medicine, we, after 7 or 8 years now, finally have consensus on the VMG AHA chart of accounts. It is, yes, 250 accounts long. It is, yes, a little more onerous, and it is also, yes, highly valuable, because there are many of us, with a special hat tip to the folks at VMG who put in time and energy into this, who have thought long and hard about what the details are behind each account. So let me just backpedal for a second. Let me talk about what a chart of accounts is. I like to think of the chart of accounts as I like to think of of your financial statements as a filing cabinet, old school filing cabinet. I don't think they make those anymore because everybody stores their stuff in Google Drive or Dropbox or some digital format. But old school filing cabinets where every drawer has a purpose. And on the right-hand side here, you can see the AHA chart of accounts. There's a drawer for assets, a drawer for liabilities, a drawer for equity. Those are the balance sheet drawers. And then on the income statement drawers of the filing cabinet, there's revenue, cost of goods sold, labor, and a couple of others, well, let's just say revenue, COGS, and labor, right? Revenue, COGS, and labor as the main drawers there. And in each drawer, there is a file folder for every kind of, sticking with P&L, every kind of revenue, every kind of cost of goods sold, COGS, and every kind of labor expenses. And we're going to talk about those in a minute. You can, in the chat, Caitlin's dropped in the link to the chart of accounts. It's a 45-page book of field definitions that gets super, super granular around describing where stuff goes, where you file every expense and every bit of revenue. Again, somewhat onerous, shameless plug for veterinary bookkeepers, not just VetBooks, but some of our other friends in the industry. There are those of us who live this, love this, and will do it for you. You can do it yourself. I do not recommend having somebody outside of the industry do it. The benefits of working with a veterinary bookkeeper is you'll never get the question from us like, who is IDEX? What is Serenia? You know, who is Covetrus? Where does Simparica go? You'll never get those questions from a veterinary bookkeeper. Okay, so that's the VMG AHA chart of accounts. At the highest level, the income statement has 4 elements. Oh, sorry, I should stop. I think I mentioned at the top, if you have questions along the way, feel free to drop them in the chat, and Caitlin will flag me. I've got a loose eye on the chat, but not totally following it. But we can make this a little interactive. There is an interactive portion coming up in a minute. So 4 key elements of the P&L: revenue, cost of sales, or cost of goods sold, expenses, and some form of profit. Here I'm showing EBIT, earnings before interest and tax. Okay, let's talk about revenue for a second. Anybody want to drop in the chat sort of some of the highlights, the top revenue drivers in practice? Somebody want to play along with me and help me out? Break awkward silence in the chat. Anybody now? That'd be awesome. You can just type your answer into the chat. Okay, I'm going to come back to this since either I'm missing the chat. I see hands raised. Oh, chat is disabled. Fixing that now. Okay, we're gonna skip this. We'll get it fixed because there's a quiz coming up. Here is top revenue breakdown. Now this is for a single practice. This isn't a benchmark. This isn't a collection of practices. This is a single practice. This is what The numbers may vary depending on the practice. And importantly, this is a GP practice, not a specialty practice. Specialty practices obviously have different revenue generators and cost generators. But you'll often see things like ref lab, prescription meds, vaccine revenue, dentistry revenue, if there's a real focus on dentistry in the practice. Exam revenue is always up top and high. Internet pharmacy revenue is super complex and a little controversial. If there's time at the end of the webinar, I'll get into the internet pharmacy revenue conversation. But this is a look at revenue, right? Money in a number of different buckets, to give you an example. Here's another look at a practice's revenue by category. Again, this is just a sample practice, but generally a split between professional services revenue, pharmacy revenue, laboratory revenue, and surgery revenue are sort of the highest categories. Again, you got to play your own game and decide what revenue categories you want to focus on, and take it from there. Okay, so that's revenue, right? Money in. The next section on the income statement is COGS, cost of goods sold. COGS are the cost of the product or service that you're selling. So it's like, it includes money spent on getting materials, on making things, and other costs directly related to those things. I like to think about, this is a true story. When I was a kid, we lived on this little cul-de-sac, and we were at the corner house, and it was a sort of this cul-de-sac off of Main Street, and I used to set up a lemonade stand on the corner. And so I often think about my lemonade stand, and if you were, my cost of goods sold when I was selling lemonade are, lemons, sugar, cups, sort of everything needed to make the lemonade is part of COGS, right? Everything else is overhead. And of course, as a kid, you never really think about overhead. At the time I was 8, I was not paying rent for my lemonade stand, or didn't have internet expense. There was no internet, so I didn't have an internet expense. COGS can also be referred to as cost of sales or cost of professional services. So let's try this again. What are some of the top cost of goods sold in a vet practice? Let's see if we get some action in the chat. Vaccines, RX meds, yes, absolutely. Pharmaceuticals, cost of pharmaceuticals, yes, through inventory costs for sure. Labor is an interesting one. Thank you, Armand. Labor could be considered COGS, although in our industry, traditionally, we do not consider it COGS. We consider it as part of operating expense, and I'll speak to that in a little bit. I'll give you an example from my own lab expenses, white goods, yes, all COGS. From the VetBooks business perspective, our account specialists that actually do the bookkeeping work are considered part of COGS. But those of us who are sort of in the background working on the business are considered operating expense, OPEX. And in vet med, really primarily labor is considered OPEX. Prescription food, another example of COGS. Thank you. So here's a listing of COGS from a practice, a sample practice. You see ref labs, meds, vaccine costs, injection costs, ultrasound costs, fluid therapy, anesthesia. So the cost of goods sold in the practice. Okay, COGS does get kind of granular. So, for example, you see in the middle of the screen here, laboratory costs can get broken down into in-house versus out versus ref lab. Pharmacy costs are, flea tick non-heartworm, flea tick combo, other prescriptions, injections, And so there's some more granularity in the COGS. And what that allows you to do is, when you know the revenue of a thing and you know the cost associated with the revenue of that thing, it allows you to create to assess your profitability on that particular item, which is part of the beauty of the VMG AHA chart of accounts. Operating expense is the third major category on the income statement. Two flavors: labor, which I was just commenting on a little bit, and all other. These are generally characterized as fixed expenses. They don't vary with revenue. So if you see one client, or you see 10,000 clients in a year, you're going to have these costs. They're fixed costs and are often referred to as overhead. And here's some examples of what those look like. So lots of labor categories in here, but you'll also see rent, you'll see credit card merchant service fees, you'll see legal, you'll see marketing, computers, just all of that fixed stuff that you have to spend money on just before you can generate $1 of revenue. Labor has 18 or 19 categories. I show them here on the right-hand side in the VMG AHA chart of accounts. It is work to analyze your labor costs, but when you do break your labor costs down this way, you can start thinking and talking about labor leverage. How many DVM dollars does it take to generate the revenue you generate? What's your RVT spend for every dollar? For every dollar of DVM cost, how many dollars of RVT spend do you have? What's your RVT spend to generate the revenue you spend? Could you spend more on RVTs and less on DVMs in multi-DVM practices? So labor leverage becomes a key conversation point here. And again, OpEx gets super granular. You see it on the left-hand side, the top grouping here, just administrative expenses alone, right? Charitable contributions, computer supplies, legal services, license and permits. It's like, it's all the nitty-gritty. And all the nitty-gritty is why I say, when I'm not doing this so much these days, but I certainly have woken up in the middle of the night sweating my business and worried about, expansion, competitive threat, growth, losing an employee, a key employee, any of those things. I always go back to the P&L and find answers in the P&L to make me feel better. Yeah. Okay. Let's play a quick game. Where would the following items go in the P&L? Your choices are revenue, COGS, or OpEx. Exam fees collected from clients. Just drop the answer in the chat. Revenue, thank you, Maggie. Yep, absolutely revenue. Payments for landscaping. OpEx, that's right. Overhead, yep, operating expense. Sutures purchased from a distributor is COGS, yep, thank you. Money paid to Zoetis for labs, also COGS, thanks. Hi, Jake. Bonuses for the staff. That's right. It is OpEx, or labor as a sub of OpEx. Wellness plan fees, number 6. Revenue, thank you, Mallory, Paula. Yeah, revenue. Money paid to a relief veterinarian. Yeah, OpEx, labor for sure. Although there is an argument to be made that relief vets could be cogs because you essentially buy their time and sell their time, but in a much more pure way than you do a DVM that's on staff. But yes, labor is right. Simparica rebates. Okay, I'll admit, Simparica rebates is a trick question. Yes, Maggie Cogs, actually. Thank you. Simparica rebates is a trick question. It is money that comes in, but it's money that comes in as a direct credit to COGS. That's right, Dr. Yankowskis. Thank you. That's exactly right. It's a credit. It's a credit to COGS. It's money that comes in that reduces your cost of goods sold. So if you think about wanting to know your true cost of goods, right? If you get a rebate, you reduce the COGS with that credit to give you a truer cost of your goods, of the goods that you then sold, which improves your profit margin on Simparica, for example. Fees collected for boarding, absolutely right. Revenue and your monthly internet bill is OpEx, exactly right. Okay, super fun. Thank you for the audience participation. Okay, so you've got revenue, you subtract your OpEx, that gives you something called gross margin. We didn't really cover gross margin, but it's a form of profit, right? So a way to think about gross margin is you have your revenue, you subtract your cost of goods sold, and what's left is money left over for fixed expenses and profit, right? Because ultimately the P&L is a zero-sum game, and I'm going to speak to this in just a few minutes. Ultimately, the P&L is a zero-sum game. You can increase your revenue or decrease your costs. And when you increase your revenue and you decrease your costs, your leftover profit is affected, right? Increase your revenue and your costs stay the same, your profit goes up. Increase your revenue, decrease your costs, your profit goes up even more. And so you've got your revenue, you subtract your cost of goods sold, that leaves your gross profit, right? Money left over for operating expenses and profit. And when you take out your operating expenses, you have your profit. So the problem is that profit has it's a bit of a chameleon. It has a lot of different, goes by a lot of different names. EBITDA, earnings before interest, taxes, depreciation, and amortization, is a form of profit. Net income is a form of profit. Operating margin is a form of profit. Profit is profit, and net margin is profit. So for people often throw around like, what's my EBITDA, right? So EBITDA, but when they say EBITDA, they mean profit. But the simplest conception of profit is probably just operating profit. It's like straight up simple revenue minus your COGS minus your OpEx is your leftover profit. And there's good reason to calculate to consider your operating profit, namely because taxes are out of your control, depreciation of your capital equipment is totally out of your control. And so revenue is in your control, COGS is in your control, OpEx is in your control. And so operating profit as a result is in your control. It's the most straightforward calculation of profit. And so when I talk about profit, I'm really most often, even if I say EBITDA, I usually just mean operating profit. And I would argue that for most people on this call, when you talk about, when you say EBITDA, you actually mean operating profit. Okay, so what does it look like? So this is a chart that shows the relationship between revenue, OPEX, COGS, and operating profit. This is something we produce for our clients on a monthly basis. And you can see revenue is the big green bar, OPEX is blue, COGS is purple, and the resulting orange line is the percent that's left over after you subtract OPEX and COGS from revenue. And what I love about this visualization is it allows you to gamify the operation of the business, right? Make the green bar as big as it can be, make the blue and purple bars as little as they can be, which makes the orange line as high as it can be. Now, this happens to be a practice that is absolutely crushing it. You know, the worst month is a little less than 10% operating profit, and their best month is, you know, close to 27, 28% operating profit. That is a very successful practice. Generally, again, not encouraging people to compare themselves to others, but you know, you have to think about what's a number that you're happy with. If you've got a $5 million revenue business, that's a big business, and 7 or 8% on $5 million is still a lot of money. Would it be nice for it to be 12 or 15 or 20% on $5 million? For sure. But 7 or 8% is, you know, leaves a lot of profit. It all depends on what your particular individual goal is. I like to show this chart because it's important to remember that profit is not cash flow. And this goes to this point around sort of going a little beyond operating profit, right? So the first 3 bars here show, you know, $670,000 coming in, right? $132,000 worth of cost of goods sold, and $400,000 worth of OPEX, leaving a little bit of cash, but there is still other demands of cash. So first of all, there's other income that comes in. These are random one-time things that, you know, like a tax return, for example, that had a positive tax return coming in would be other income. You've got balance sheet items like changes in liabilities and changes in inventory, things that are kind of beyond your control, that ultimately lead to your actual cash. So you have to remember there are drains on cash outside of the operations. But again, what can we control the most? We can control revenue, COGS, and expenses. And so these top 3 in this waterfall are a good way to look at the information. Okay, so quick review: 4 elements of the P&L: revenue, COGS, OPEX, and profit. And now that you've got those building blocks, we can start to analyze. And again, there's a ton that you can do around analysis. Remember, the P&L tells a story. And so this is really more about what questions do you have about your business and how can you answer them through the P&L. So the first thing that I like to do is I like to look at trend lines, right? So every month you should be looking at, how did I do this month versus the same period last year, and how am I trending? So on the left-hand side of this chart, you see revenue up or just equal to in the March bullet there, you see just equal to or just slightly above last year. and so revenue is up, and COGS down below is being held almost constant, is up slightly, but I would say on average they're about equal. So you look at that and like, this is why good, clean financials are an investment in your in your ability to sleep better at night. Because I look at that and I'm like, okay, I'm trending up on revenue, and my COGS is constant or a little below, which to me says my gross margin, right? The money that I have left for operating expense and profit is up, right? I'm up on revenue. I'm constant on COGS. My gross margin is up. Story gets a little, the plot thickens a little bit though, because as you look at operating expense in the middle bucket, there we're having a tougher go, right? OpEx is up across the board quite a bit every month over last year. And while that's disappointing, again, it's important to play your own game. While it's disappointing, if you know the reason why OpEx is up, if you don't know the reason why OpEx is up, you have a problem, right? If you know the reason why OpEx is up and where it's up, you can then say, okay, well, that was a strategic choice that I made, right? Hired a new doctor, gave people salary increases, bought new computers for the entire practice, which the cost would be spread out, but if you bought a lot of them, it could impact the operation, right? These are strategic decisions that you can make that are totally within your right to make. It's just knowing what the effect of them is on the business. So OpEx is up, COGS are constant, revenue is up, and you see on the profit line, profit is, at least for the first 6 months minus a spike the previous year, is constant and growing. There's a story here. The P&L shines light on what's happening in the practice and where you need to focus your time and attention. The next category that I like to talk about is your percent of total revenue. What percent of total revenue is represented by the various categories at a high level, right? So you have revenue. If revenue is 100%, so in this case, practice had pulled in almost $700,000 in June. Cost of goods, cost of sales, cost of goods was about 20%. That leaves 80%. There's that gross profit that I was talking about. 80% is left for expenses and profit, right? Expenses are 60% of the 80%, so $400,000 leaves operating profit of $130,000, almost 20%. Now, I pulled this sample a couple of years back because it almost perfectly mirrors what is held as a guidepost, a good guidepost in the industry, and one that I really like to use as a starting point. Again, aware and cautious of my comments about benchmarking, right? I believe that you should not be looking left and right at what other people are doing and what your numbers should be, but rather understanding your numbers and making your business sing and dance for you. However, as a starting point, right, there is this rule of 20. I refer to it as the 5 buckets, right? Where revenue equals 100% of the money that's come into the practice that is going to be distributed in these 5 buckets. This is a zero-sum game. There are just no two ways about it. All revenue into the practice is going to go into one of these 5 buckets. You don't have a choice. You have a choice about which buckets it goes into, but that it goes into one of these 5 buckets, you don't have a choice. So if you think revenue is 100% and you can hit approximately 20% COGS, 20% DVM labor, 20% other labor, and 20% OPEX, that leaves profit of 20%. And I can hear some people screaming at the screen saying, how am I supposed to get my labor to 20%, DVM, 20% other labor? How am I supposed to get my labor cost to 40% of revenue? Aren't you paying attention, Traub-Werner? The labor market's super tough. You can't hire people. New grads want a ton of money. Yes, all of that is 100% true. And it is fine to be above 20% on your DVM labor and 20% on your other labor. The problem is that money's got to come from somewhere. So it's either going to come from OPEX, or it's going to come from COGS, or it's going to come from profit. And so this is about which levers can you pull in the business and manipulate to maximize profit. Because I have news for you, and I've said this before, I'm kind of on record. Working in a profitable business is way more fun than working in a non-profitable business. Let me say that again. Working in a profitable business is way more fun than working in a non-profitable business. It's more fun for everybody. You can just do more stuff when there's profit in the business. Profit is not a 4-letter word. And I have a whole other webinar presentation that I do with Dr. Danny Rabwin about balancing care and capital, which we'll roll out again here before too long, because it's a super important topic. So profit is important, and it only comes from minimizing your COGS, your DVM labor, your other labor, your OPEX, or maximizing revenue, right? Another way to lower the percent of your labor costs is to increase revenue without adding more headcount. Practice efficiency, right? Which is easy for a guy like me to stand in my home office and say, and harder to actually execute. I know. But this is straight math. And I love it. I love it because it really simplifies the P&L. This is what it boils down to. And so am I saying that you have to hit perfect numbers 20, 20, 20, 20, 20 across the board? No, by no means. But whatever number you hit, appreciate that it all is going to add up to 100% of revenue. And if you look at the percentages in these buckets and you start to get comfortable with them and how you can manipulate them and be strategic about working on particular initiatives to change and challenge these buckets, you can be wildly successful as a business owner. So there, I'm going to get off my high horse about the 5 buckets. I'm super passionate about this. It's super important. Okay, another couple of quick points, and then we are going to, I'll open it up for questions, and 2 or 3 more slides. I'll open it up for questions, and we'll try and give people 5 minutes time back at the end. Granularity on this percentage of revenue. For example, if total lab revenue represents 20% of your costs now, of your costs. If total lab revenue is 20%, and 17% of that's coming from your ref lab, then you probably want to try and minimize your ref lab rather than trying to be more efficient with your in-house lab. And so, sorry, let me come back to that again. If for any one category, I want to focus specifically on lab revenue, but for any one category, for any one revenue category, knowing where that revenue is coming from, is where you can focus your time, how to focus your time and attention. Another way to think about this is the bar chart that I showed earlier, where if you organize your revenue in descending order by dollar, that is where you should pay the most time and attention. Do you want to pay time and attention, now coming back to the ref lab, do you want to pay time and attention to something that represents 17% of your revenue or 3% of your revenue? Do you want to pay time and attention to, anesthesia revenue? Like, somebody comes to you and says they've got a better way for you to improve your anesthesia costs, and by changing your anesthesia pricing. It's 0.4% of your revenue. Don't spend time and attention on your anesthesia revenue. Know what the big buckets are that can move the needle. And then another, if you'll permit me, another sort of a bee in my bonnet. In the middle of the second chart here, there's fee discounts. I 100% believe that you should be itemizing your discounts in your PIMs and on your income statement on a regular basis. I am totally fine if people want to give a discount. You can discount 80% of your service for all I care. But you have to have the intellectual honesty to count how many dollars you're giving away in discounts. And we run into way too many clients who haven't itemized discounts on their P&L, and as a result, don't really know what percent of their total revenue they're giving away. So here, for this practice, for this time period, they gave away $15,000 of discounts, which represented 2.3% of revenue. I got news for you. If you're only making 8% profit and you're giving away 2.3% of your revenue, you could be a 10.3% practice by not discounting. So discounting is emotional, it's sometimes controversial, it's often necessary, but you have to have the intellectual honesty to account for it, and know what percent of your revenue you're giving away on a monthly basis. Turns out that I've got very firm opinions on a number of these topics. Okay, last concept to introduce on analysis is ratios. I said earlier today, earlier in this presentation, if you know the revenue of a thing and you know the cost of that thing, you know how much profit you're generating off of that thing. And you do that with something called an revenue to expense ratio, right? If I've got $8,100 worth of therapeutic diet revenue and $5,500 of diet cost, I've got an expense ratio of 1.48. That means for every dollar of revenue I bring in, of every dollar I spend on therapeutic diets, I'm making 48 cents when I sell it. Also known as a 50% profit margin, right? 48% profit margin. And looking at another example, your outside ref lab costs, I spend $30,000, I earn $76,000, I have a revenue to expense ratio of 2.56. I make $1.56 for every dollar I spend in ref lab costs. So the first on that expense ratio, 2.56, the first, it's also 2.56 is the same as 256%. The first 100% cover my costs. The remainder is my profit margin, 156%. So as between these two, where do you want to, what do you want to sell more of? Do you want to sell more? And this is a false dichotomy. It's not like it's not like anytime you spend time selling therapeutic diets, you can't be selling ref lab or focused on ref lab revenue. But as between the two, getting your team to focus on ref lab revenue leaves more money for OpEx and profit than having the team spend time on therapeutic diet products. And you know this if you are detail oriented in your P&L. Some other analyses that you can do, there's balance sheet analysis, there's other benchmarking against other practices, although you now know how I feel about that. And there's budgeting and scenario planning where you can use this month's P&L, this year's P&L, to prepare a pro forma, a forward-looking forecast, a budget of how you want next year to pan out. And scenario planning says, okay, what if a competitor opens up and 15% of my revenue disappears? What if I hire a new vet and we increase our revenue by 15%? What are the costs and revenue associated with that activity? So financial analysis, in summary, financial analysis is where the storytelling happens. It allows the analyst, advisor, consultant, frankly, practice owner to decipher what's happening in the practice. And what I love about it is, and this is why it speaks to me personally, is it speaks to my natural curiosity. If you've got curiosity about what's happening in a business and you have clean, reliable data, you've got the P&L, which is a super powerful instrument to satisfy those natural curiosities. I have ended with 7 minutes left to top it off. I thank everybody for their time and attention, and to those of our clients on the call, I thank you for your continued confidence in our team. I'm happy to stick around for questions, and I can stick around a few minutes after if people want. But this ends the formal presentation. Thanks, Jay. David has a hand up. Caitlin, you want to unmute David if you can, or go ahead, David. Oh, you got unmute.
Yeah, can you hear me?
Yes, if I can.
Okay, yeah, I was just wondering if you could talk a little bit about that internet pharmacy cost, the revenue as well as the costs. It's something the doctor and I have discussed and argued about many times.
You are not the only people discussing and arguing. Yeah, you are not the only people discussing and arguing. The VMG AHA chart of accounts currently has internet pharmacy costs in COGS as part of COGS, and the argument goes that because it is such a large cost, and you essentially get the benefit to the practice is really just the revenue minus this very large cost in the form of a check from an internet pharmacy, or bills to home or Chewy or whatever. that it's not, it unnaturally skews overall COGS. It makes COGS appear higher than they are. I'm assuming that that's the
It
experience that you're
is.
having in the
It
practice,
is
right?
because it's getting next to impossible to get our COGS down to that 20%.
Correct. That's correct. And so that is technically by the book, by the VMG AHA chart of accounts book that we've all agreed to play by, that is the way to do it. Now, there's a very active dialogue in the accountancy and bookkeeping community around moving internet revenue and internet expense below the line. So you would have the things that you are more or less in control of, and I'm not to say you're not in control of internet pharmacy revenue. You are less in control of internet pharmacy expense. But taking that, the difference between revenue and expense, and putting it as a line item below operating profit. And I think you will see movement on that probably in 2026.
So do we think people that are still able to reach that 20% COGS are playing the game correctly, or do they just have such amazing numbers that it's working out for them?
I think it's a little of column A and a little of column B. I think some people have listen. There are some people who have just not who have uh, who are still anti-internet pharmacy, right? Like, it also depends on what your internet pharmacy strategy is, right? Do you lean in and go all into the internet pharmacy, or do you say, look, I'll do internet pharmacy when people call me and say they have a competitive price? I'll say, okay, you can buy it on my internet pharmacy at that price. So it also depends on what your strategy around internet pharmacy is. But there are some people that are very aggressively managing their COGS, and maybe they're not at 20, but they sure are at 22, 23.
Okay, thank you.
That answer the question? It's not a great answer, but it it's a known irritant. And I
Yeah.
literally have been emailing with a couple of the um, uh, veterinary accountants and other people on this particular topic. Uh, that there is a change coming to the AHA BMG chart of accounts, a broad change, like not a wholesale redo by any stretch, but sort of 30, maybe 25 or 30 little tweaks. This would be one of them, but I'm advocating for this to be advanced for the start of the new year. So stay tuned.
Thank you.
Okay, thanks, David. Okay, barring other questions, Natalie, I see your question about an in-depth webinar for P&Ls. I suppose it probably is time to go, and it would probably actually need to be a workshop where we take an actual P&L and ask 5 or 7 questions about that business and sort of really dig into each of the questions, which actually, in a very weird way, sounds super fun. And I will make a note of that. Okay, it is 10:59 Pacific. I'm going to say thank you to all those in attendance, and if you do have any questions, comments, concerns, please feel free to reach out to me. My contact information was in the chat earlier. I'm also super easy to find on LinkedIn, or just Martin at vetbooks.com. Thank you, everybody.